Ever wondered where money actually comes from? We use it every day, but its origin story is way more fascinating than you might think. Is it all just printed by the government in a giant factory? Well, that's part of the story, but it's not the whole picture. Get ready, because we're about to demystify money and uncover how it truly works. Let's start with what most people think of as money. Physical cash, the coins and bills in your wallet. This is what economists call MO. It's created by a country's central bank. Like the Federal Reserve in the US, they literally print banknotes and mint coins. But here is the mind-blowing part. This physical cash makes up only a tiny fraction of the total money in the economy, usually less than 10%. So, if most money isn't physical, where is it? The vast majority of money exists only as digital numbers in bank accounts. This is where commercial banks, the ones you and I use every day, play a huge role. This system is called fractional reserve banking. Here's how it works. When you deposit, let's say, $1,000 into your bank, the bank is legally required to keep a small fraction of it, maybe $100, as a reserve. This is the fractional reserve. But what happens to the other $900? The bank doesn't just let it sit there. It loans that money out to someone else. Maybe a person takes out a loan to buy a car. Now, that person has $900 to spend, and you still have your original $1,000 in your account, which you can access any time. In an instant, the money supply has grown from $1,000 to $1,900. That $900 of new money was created out of thin air just by issuing a loan. The process doesn't stop there. The car dealership that receives the $900 deposits it into their bank. That bank then keeps a fraction, say $90, and lends out the remaining $810. Each new loan creates new money, expanding the total amount of money circulating in the economy. It has a powerful cycle that fuels economic growth by making credit available for businesses to expand and for people to make large purchases. So who controls all this? The central bank. They have tools to manage this money creation process. Their main tool is adjusting interest rates. When they lower interest rates, it becomes cheaper to borrow money. This encourages more people and businesses to take out loans, which leads to more money being created, stimulating the economy. On the other hand, if they're worried about the economy overheating and prices rising too fast, a situation known as inflation, they'll raise interest rates. This makes borrowing more expensive, slowing down lending and consequently slowing down money creation. So, in a nutshell, money isn't just printed. It's mostly created digitally through the banking system's lending process, all overseen by the central bank. It's a complex dance between deposits, loans, and interest rates that shapes our entire economy. Understanding this gives you a whole new perspective on the financial world. Pretty cool, right? If you found this explanation helpful, don't forget to hit that like button and subscribe for more insights into how the world really works. Thanks for watching.